Welcome to the deep dive. Okay, if you're checking your portfolio right now, you know exactly what's happening. The volatility is definitely back. We just saw this incredible run, a new all-time high above $126,000, and then almost immediately, boom, the profit takers arrived, really slamming the brakes. So the mission for us today, for this deep dive, is to try and cut through all that noise. We need to look at this short-term technical pullback, the price drop, and weigh it against what seems like a landmark set of fundamental announcements. Stuff that signals real, maybe irreversible, market integration. What's the actual signal here we need to focus on?
It's a noisy environment for sure, but I think the signal is definitely clear, actually, despite the market maybe feeling a bit shaky right now. Price is sort of consolidating, bounce around $121,897. But the bullish case, the long-term one, it's really accelerating. You've got two huge things happening at once. This sustained macro boost from the U.S. government's shutdown, which is still going, and maybe even bigger, a truly monumental, $2 billion strategic investment connecting traditional finance, TradFi, directly into DeFi infrastructure. That's huge.
Okay, let's start with that immediate price action, though, because it was sharp. Bitcoin dropped, roughly 1.8% in the last 24 hours? That's the biggest single-day dip we've had since late September, right?
Correct.
We know the usual answer is profit-taking after a new high, but where are the technical analysts saying the market absolutely has to hold its ground? What are the key levels?
Right, so the market's in this classic technical reassessment phase. Immediate support, maybe around $120,000. It looks a bit soft, honestly. Everyone is watching the really critical support level near $117,000.
Okay, 117K. Why that number specifically?
It's important because the on-chain data, looking at the blockchain itself, shows that about 190,000 Bitcoin were acquired right in that zone. So it represents the cost basis, the entry price, for a huge volume of holders. That's where you'd expect really serious buyer defense to kick in, people protecting their entry points.
Makes sense.
Now, if that massive $117,000 level fails, and it's a big if, analysts are pointing towards a potential downside target, maybe a plunge toward $114,000. That kind of fast move, if it happens, is often driven by, predatory traders, you could say. They actively target those liquidity pools, the buy orders clustered around levels like 114K, trying to force liquidations, especially from traders using too much leverage.
Right, the over-leveraged positions get wiped out.
Exactly. And on the upside, that previous all-time high zone, roughly $124,000 up to $126,000, that now acts as pretty strong overhead resistance. Sellers are likely waiting there.
Okay, so it sounds like a bit of a minefield, potential-wise, which kind of lines up with some analyst sentiment I saw. Economist Timothy Teterson's simulation for October, it shows these wildly diverging possibilities, like a 50% chance of finishing the month above $140,000. But almost the same odds, 43% chance of finishing below $136,000. That's a huge range. How do we square that uncertainty with what traders are actually doing right now?
Yeah, that's a wide range, isn't it? Well, we look to the derivatives markets for clues. There's an indicator called the net taker volume. It basically tells us if aggressive buyers or aggressive sellers are dominating the market at the moment. Recently, that metric hit a really deep negative reading, like minus $400 million, showing sellers were firmly in control, pushing the price down. But significantly, it has since shifted back towards neutral.
Ah, okay.
That suggests an exhaustion of that aggressive selling. The short-term pressure that caused this dip, it might just be wearing itself out.
Interesting. Okay, on that note then, let's maybe connect this technical volatility back to the bigger picture, the macro stuff. That U.S. government shutdown is still ongoing. It's dragging into its second week now. And you still hear the argument that this political dysfunction reinforces Bitcoin's appeal, as a hedge against sovereign risk.
Yeah, and what's really fascinating here is how the narrative around the shutdown has kind of evolved. Initially, the catalyst was just the shock of it happening, right? That bolstered what people call the debasement trade.
The idea that government dysfunction hurts the dollar.
Exactly. The thesis that sustained fiscal problems, political gridlock, they erode the currency's value over time, pushing investors towards assets like Bitcoin, which are decentralized and have a fixed supply. So the sustaining factor now isn't just the shock, it's the perceived intractability. The ongoing dysfunction itself seems to strengthen Bitcoin's long-term case in some investors' minds. But there's a new wrinkle, a new variable. Publicly, yeah, the gridlock looks total. But there are reports, sort of behind the scenes, indicating quiet, informal negotiations. A bipartisan group of senators apparently looking for a compromise, maybe focusing on health insurance issues first.
Okay. If those talks are actually happening, even informally, how quickly does the market usually react? Does it start pricing in a potential resolution? Does that create an immediate risk of like a sell the news event if those talks gain traction, even if the shutdown itself is still technically on?
Oh, absolutely. The market has to price in that possibility, however remote it might seem today.
Right.
While the shutdown is, undeniably a strong tailwind for Bitcoin right now, its eventual end is a future risk factor. So if a potential resolution starts to look more credible, yeah, you could definitely see some hedging, maybe some profit taking from traders who jumped in purely because of that macro risk.
Right, the shutdown trade unwinds a bit.
Could happen.
Okay, so that macro picture kind of sets the stage. But I agree with you. I think the biggest story here, the real fundamental signal, has to be that news from Intercontinental Exchange, IC, parent company of the New York Stock Exchange. Is this the biggest institutional validation we've seen all year? It feels massive.
It is historic. I don't think that's an exaggeration. IC announced a strategic investment, potentially up to $2 billion, in Polymarket.
Polymarket, the decentralized prediction market platform.
That's the one. And this was an all-cash deal, which is important. It reflected an $8 billion pre-investment valuation for Polymarket. Just think about the gravity of that number. $8 billion valuation, $2 billion investment from ICE.
Hold on, hang on. $2 billion, all cash. ICE just basically bought itself a massive long-term bridge straight into the heart of decentralized finance, didn't they?
That's exactly the takeaway. Yes, this isn't just, an investment in some crypto service company. This feels like the most profound validation yet of DeFi infrastructure itself. We're talking systems built entirely on smart contracts, getting this huge nod from one of the world's most established traditional financial institutions, and the details on collaboration are even more telling. ICE plans to distribute Polymarket's event-driven data to its own institutional clients. And, crucially, they'll collaborate on future tokenization initiatives.
Wow.
ICE is positioning itself very deliberately, it seems, to be a primary architect, a builder of future tokenized asset markets. It's not just participating, it's aiming to shape them.
That level of conviction, that scale, it's clearly cascading down into corporate treasuries too, isn't it? We saw Juicy Holdings, NASDAQ Q-listed company, they announced a phased rollout of a $1 billion crypto acquisition plan. $1 billion, with their first Bitcoin purchase kicking off within just 2 weeks. That's a staggering commitment from a public company.
It really is. And it's not just about throwing money in either. Look at Neptune Digital Assets.
Yeah, I saw that. They grew their Bitcoin treasury to over $70 million Canadian, which is, over 410 BTC now?
Right. And importantly, they didn't just buy it lump sum. They achieved this using a really sophisticated multi-pronged strategy. It includes dollar cost averaging, sure, but also converting staking rewards from other digital assets they hold, using derivatives strategically, and even mining.
That shows real treasury management sophistication, not just speculation.
Absolutely. It's becoming a serious treasury asset class. And the playbook is definitely global now, too. It's not just North America. You had ZOZ Power in Israel, adding 329 BTC. That brings their total holdings over 854 BTC, valued well north of $100 million now. And the Smarter Web company over in the UK, they increased their holdings to 2,550 BTC. So the corporate adoption trend is just undeniably accelerating across different continents, different industries.
Okay, so this shift towards more sophisticated management, the ICE news, it leads naturally into thinking about market maturation, right? The industry seems focused on broadening the investor base, getting beyond just those comfortable with, let's face it, pretty extreme volatility sometimes.
Exactly. And this is where financial product innovation becomes really key. We just saw the launch of the Calamo Structures Protection Bitcoin ETFs. Now, these are fascinating because they're specifically engineered to offer defined downside protection over a one-year period.
Defined protection, how does that work?
Well, take their CBXO ETF as an example. It's structured to limit an investor's maximum potential loss to only 10% over that year. But it still offers upside exposure up to a predetermined cap, which, when it launched, was set at 23.43% potential gain.
Okay, so limited downside, capped upside. How do they guarantee that?
They achieve this sort of defined outcome using complex instruments called FLEX options. It's a strategy borrowed from traditional structured products.
Got it. So, to put it simply, this is basically Wall Street offering training wheels for institutions, isn't it? It defines the risk, packages it up neatly so that maybe pension funds, registered investment advisors, the more conservative players, they can finally step in without their compliance departments having a complete meltdown over the volatility.
That's a perfect way to put it, yes. It directly addresses perhaps the single biggest barrier for many institutions, Unpredictable, potentially unlimited downside risk. This caps it.
Solves a huge problem.
It does. And you see the infrastructure being upgraded at the same time to support this institutional flow. Bullish, the exchange, just partnered with Deutsche Bank
Oh, yeah. For what?
to provide really seamless fiat integration dollars, euros for institutional clients trading on their platform. Just reduces friction, reduces counterparty risk, things institutions absolutely demand.
Okay, so given all this positive news, the ICE deal, corporate buying, these new structured ETFs, better infrastructure, how strong is the institutional bid actually holding up during this current price dip? Are they still buying?
Oh, remarkably strong. It's quite telling. The latest spot ETF flows update we have, from October 7th, showed a net inflow of a substantial $875.6 million in one day.
Wow, nearly $1 billion flowing in despite the price correction.
Exactly. And this overwhelming institutional accumulation was massively led by BlackRock's IBIT fund. They pulled in almost $900 million just on their own.
So IBIT basically accounted for more than the total net inflow, meaning other funds saw outflows.
Precisely. There were some outflows elsewhere, but BlackRock's demand just dwarfed everything. It confirms that while maybe some short-term retail holders are taking profits off the table after the run-up, institutions, or at least a very large segment represented by BlackRock's clients, are aggressively using this consolidation period, this dip, to accumulate more. They see it as a buying opportunity.
That's a very powerful signal. Okay, let's shift focus slightly for the last bit here. The global regulatory landscape. It feels like nations are now actively competing for this industry, which is leading to some really different policy approaches around the world.
Yeah, the divergence couldn't be starker, really. You've got a clear split emerging. On the restrictive side, look at Poland. They just passed a really strict implementation of the EU's big crypto regulation package, MiCA. It imposes high capital requirements on crypto firms, hefty fines, even potential prison terms. Very tough. Similarly, Turkey is granting its financial crime regulator, MASAC, pretty broad authority to just freeze and shut down crypto accounts they suspect of illicit activity. That's a very control-oriented approach.
Okay, so Poland and Turkey tightening the screws. What's the contrast?
Well, the direct contrast is the UK. The Bank of England is now actually planning to grant exemptions to its own previously proposed very strict caps on corporate stablecoin holdings. They initially suggested a cap around £10 million, which caused a lot of industry pushback. Now they're backtracking.
And the reason for the UK pulling back on those strict caps, it's purely about competitive survival, isn't it?
Right.
They looked across the channel, saw the EU rules, looked at the US, and realized strict caps would just send capital, send businesses flowing elsewhere.
Precisely. It's a textbook case of regulatory arbitrage playing out in real time. The UK's move essentially validates the concept. Capital, innovation, it flows to jurisdictions that manage to strike the best balance between robust oversight, which is needed, and a pro-growth, pro-innovation stance. And this dynamic, this competition, is actually accelerating the adoption of more sensible, balanced frameworks globally, because countries are realizing they literally cannot afford to miss out on this industry by being too restrictive or unclear.
Okay, so let's try and synthesize all of this then, pull it together for you listening. That price correction we saw, the 1.8%, maybe even 3% drop from the highs, that looks mostly like technical noise right now, necessary consolidation after a big run. The critical support zone everyone's watching is that $117,000 level, with maybe $114,000 as the floor if things get really shaky.
Correct. But the fundamental adoption news, that huge ICE investment bridging TradFi and DeFi, the new billion-dollar corporate buyer stepping in, the launch of those structured risk-managed ETFs, that is the powerful market-defining signal right now. You get the sense that long-term investors, the institutions, are largely treating this current dip, which seems driven by necessary technical profit-taking, mostly as an accumulation opportunity, because fundamentally the drivers for long-term growth, the integration into the mainstream financial system, they arguably have never looked stronger than they do right at this moment.
All right, and finally, maybe a thought for you to carry forward, building on that regulatory point. Considering how quickly the UK pivoted on those stablecoin caps, driven purely by fears of losing out to the US and EU, what's the next major financial center, maybe think Hong Kong, Singapore, perhaps Dubai, that might feel forced to relax its own rules soon? Which hub will blink next to avoid losing substantial capital and talent to this powerful global trend of regulatory arbitrage? Something to definitely keep an eye on as you watch the markets evolve.